Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. Today, we'll talk a little bit about taxes and tax planning, but also think about what happens to the overall government tax receipts when there are changes to tax laws. And then we'll tie that into how we address tax planning for retirement, because it's always all tied together. So one of the things I've been hearing over and over and over ever since the election results is that there's going to be some tax cuts. Will there or not? I don't know. But the concern over the tax cuts is that there will be less tax receipts for the federal government. And I found that thought interesting because I keep hearing that over and over and over again. But I know from looking at the data recently and also in the past that that's not actually necessarily the case. When people say, well, they're cutting tax rates and therefore the government's going to get less money, the answer is a resounding maybe. We can look back at past history, and I'll go through that in a second, and we can see points where taxes were cut, the tax rates were cut, and receipts did go down. But we can see other instances where there were tax cuts and the tax receipts actually went up. Let's look at the most recent one, which is the Tax Cuts and Jobs Act back in 2017. So it was signed in 2017. It went into effect in 2018. So with all these tax cuts, where it cut not only the corporate tax rate, but also the individual tax rate and added in several other deductions and increased the standard deduction, a lot of people logically think, well, if the rates go down, the government's going to not collect as much money. And I think that's the thinking this time around as well, when they're talking about potential rate cuts. But if we look back at the data, which is pulled directly off of the U.S. Treasury's website, they have reports on there where it'll show the most recent year, comparing it to the past couple of years, but they also have all the historical reports. So we can go back for a long time and look at the data. But we pulled all that data for the last 2 decades. And we can see very clearly from the data that in 2018, after the tax cuts happened, the total receipts by the federal government did not decline. It went up slightly. Didn't go up much, but it went up slightly despite all the different tax cuts. And when we look at the government receipts, it's going to break it down into different areas. It's going to show individual income tax, corporate income tax. It'll show the FICA, so Social Security and Medicare. It'll show excise taxes and other taxes like estate taxes and things like that. The bulk of what makes up receipts are individual income taxes and also the FICA and Medicare tax that gets collected. What is misunderstood is there's always a line for the corporate tax, and it doesn't look very big. In fact, if we look at 2023, it was roughly just shy of 10% of the total receipts for the federal government came from corporate income taxes. And a lot of people's immediate reaction is, well, corporations should pay more. That's not what's happening with these percentages, though. What we have to understand is that most businesses are either structured as a partnership or a sole proprietorship or, say, an S corporation. All the income from those businesses flows through to individual tax returns. It's only C corporations that pay their own taxes under C corporation tax rates. So when we talk about corporate taxes that the federal government receives, it's only from C corporations. All the other businesses, that business income flows through to the individual income tax returns. And that's why you see the individual income tax returns so much higher in terms of government receipts than corporate tax returns. So that's lesson one for the day, is that for all the screaming and shouting over what corporate tax rates could be, the changes in those rates are not going to be significant. It's not nothing, but it's not significant to the overall federal government tax receipts on an annual basis. Every little bit counts, but whether it's 22 or 28 or 25 or whatever, the tax rates are important, but it's not going to change the world. So we just have to put these different pieces in perspective. And I bring up the corporate tax rate because in 2018, which we're looking at, that rate, the receipts from corporate taxes actually did decline. And then they picked up in subsequent years. But there actually was a 1-year dip in corporate tax receipts. On the other hand, all the other tax receipts to the federal government continued to go higher. So, yes, there was a 1-year dip in the corporate tax receipts, and then it continued to move. Everything else continued to march steadily higher, despite there being a cut in tax rates. So then I was curious and wanted to look back a little further in history and see where were there other tax cuts and what was that impact, to see, was this just a fluke? Is this a normal occurrence? Or what do we see from past history? So let's turn back the clock to the 2000s. So George Bush was president at the time, and there was a round of tax cuts in 2001, and then a second round, a different round in 2003. The one in 2003 actually cut the capital gains and dividends rates, whereas 2001 was decreasing the top individual tax rate and also increasing child tax credits. What we see is that in 2001, there was a brief dip in federal tax receipts, but then it quickly rebounded after that. In 2003, when they did the cuts to the capital gains and dividends taxes, what we actually saw was an increase in tax receipts. So, same president, same term, in fact, two different tax cuts, two different immediate results, but in both cases, the government receipts continued to climb higher. So let's go back to the 1980s with Ronald Reagan in president. So in 1981 and then also in 1986, there were again two different rounds of tax cuts. In the first time, the total receipts did decline, but rebounded pretty quickly as the economy grew. And then in 1986, the receipts from individual taxes actually increased after a really, really brief dip. So in both cases, we saw some dip, but then a pretty quick rebound. So it's just interesting to go back in history, and we can actually even take this all the way back. Let's go back to 1964. Lyndon Johnson is president, and they cut the top tax rate and also lowered corporate taxes. And what we see in that case was that actual receipts increased. How many different examples? Now that's 6 different examples. One with Lyndon Johnson in the 60s, 2 with Reagan in the 80s, 2 with Bush early this century, and 1 with Trump in 2017. And in all those cases, the actual results from the initial results from the tax declines was mixed. Some, there was a brief dip and then it rebounded, and others, it immediately increased. So what we're really seeing is a mixed history of what happens when these tax cuts are put into place. And what it shows and that really highlights is that there's more to it than just the tax rate. It depends on how the economy is doing. It depends on what businesses are doing, what individuals are doing in their own tax planning. There's a pretty broad range of different issues that will impact the actual tax receipts of the federal government. So it's just important that we not immediately assume that, okay, there's a tax rate cuts, therefore the government's going to get less revenue. Could that happen? Absolutely. Is it guaranteed? No, not at all. In fact, we just went through examples where that did not happen. where tax cuts were enacted and the government actually brought in more money. So just want to highlight the fact that that's not a foregone conclusion that the federal government will get less money out of tax cuts. Also want to highlight one more thing before we tie this into retirement planning, and that is if you ever get into any sort of debate about tax rates, and I don't recommend doing that, but if you ever find yourself in some debate about tax rates and what they should be, please remind yourself and everyone else involved that the number one most important factor in how much receipts the government takes in from taxes is the economy. So if somebody says, oh, the tax rate should be this, or it should be this, or it should be this, just say, hang on, one word, economy. It far outweighs whatever the tax rate is or somebody wants the tax rate to be. And we saw a clear example of that after the financial crisis and the Great Recession, where uh, if we look back at a longer history, tax receipts continue to climb on a steady basis, except when the economy's not good. And we saw that where we had a significant drop off from 2008 to 2009 in tax receipts. The total tax receipts in 2008 were about 2.5 trillion. That dropped to 2.1 trillion in 2009. And actually, it took all the way until 2013 for the tax receipts to catch back up to what they were in 2008. That's a pretty significant period of time for the government to be losing out on revenue because the economy was not in good shape. So again, anytime somebody wants to debate rates or tax policy or whatever, just say economy. Tell me how the economy is doing. That'll tell me how much the government's going to take in tax receipts. Now, let's tie this into retirement planning, because that was a pretty long history and discussion. I hope you find that as interesting as I did, just to look at what drives income tax rates and income tax receipts for the government. Let's tie this into tax planning. Because when we look at tax planning and retirement, the one advantage that we have is that we can focus on a much longer period of time. The government is looking at things from year to year, or maybe even 2 years at a time. Maybe they're usually looking at things from year to year and figuring out what the receipts are going to be and what money's going out the door. And lately, too much money's been going out the door. As we've just seen, there's only so much you can do with tax rates and different tax policy to increase the revenue to the government. Even if you were to increase rates, that doesn't necessarily mean increased receipts to the federal government over the long term. So, one, they need to control the spending to match what the receipts are, because there's only so much you can do to increase the receipts outside of having the economy go even better than it is. So, they look at things year to year in terms of budgets and what's coming in, what's going out. With retirement planning, we can look at decades and say, when do we want to try to maybe accelerate taxes in order to save money over the long term? Or in some cases, how do we spread it out even further to save money over the long term? So keep that in mind as you're hearing about different changes in policies and rates. We get to control what we can control, which is the long-term planning, and how do we save money over the long term. And the other piece is to note that um, these things can change all the time. So don't get too stuck in an ideology or a thought around what tax rates might be later or what are they going to be next year. Plan for what we know now. We can maybe make some assumptions about the future, but understand that those assumptions might completely change as the world and the economy changes. One last thing is that even though we went through all of this and we just showed with some good data directly from the Treasury on the impact of tax rates and how sometimes lowering and raising them actually doesn't impact all that much in receipts over the long term, it really depends more on the economy. We still have to understand that tax rates could go up in the future, even though the data and the facts don't necessarily support that it's going to result in higher tax receipts. It could still go up because that's just what people think will happen. So Congress can get in there and say, well, we're going to raise taxes because we think that's going to increase tax receipts. And maybe it will. It absolutely could. I'm not saying it couldn't, but it's actually absolutely a possibility. So we have to understand that with the current deficit and debt that we are building up year after year, that Congress in the future may say, hey, we need to raise tax rates. Therefore, we need to put our long-term planning hats on and say, yes, we don't know that they will in the future. They might. Let's make sure that we're taking advantage of rates now that we know are low and determine should we or should we not pay taxes now versus in the future. So that's a broad way of saying, kind of summing up everything we've already talked about, which is tax rates might change. Will it impact the federal government tax receipts? Who knows? It's a big maybe, but we can control what we can control over the long term. And you only get tax savings from tax planning and understanding what the rules are and how we can take advantage of them. So I hope everybody found that super interesting on tax rates. If you're liking our podcast and our videos, give us a like, a share, a subscribe, 5-star rating. Anything helps the video and helps spread the message and helps educate other people on retirement planning. Thanks so much for tuning into this episode. I really appreciate your support and hope you found value in the conversation. If you enjoyed it, be sure to subscribe, leave a review, and share it with someone who might benefit from it. Your feedback helps keep the show growing. Until next time, take care and stay strong as we learn